Welcome all. Welcome all to Financial Freedom. My name is Samir Bapat, and today we are going to learn how we can earn when the markets are going down. Normally, when the markets are going down, uh, the shares we have bought, they also go down, and our overall portfolio value goes down. But there is an instrument available in stock market by which you can earn when the stock markets are going down. The name of game is derivatives trading, future and options. So let me ask you one thing to all of you. How many of you know about derivatives, future and options? Can I have yes? Those who know about it. Future and options, derivative trading, anything about future and options? Okay, so you know. Okay, so you know about derivatives. Yes, okay. Okay, so Anil is saying no. Okay. So only one and yes and one no. So we have how many? Okay. Yes, no. Okay, so there is a yes, no equal. So what we are going to learn today is we are going to learn about futures and options. We are not going to learn about options. We are going to learn about futures. So it is called derivatives trading. It's a very interesting instrument. It is a very powerful instrument. Once people shift from stocks to futures, futures to options, very less people go back again to the stocks. They normally stick to the options world. So it's a very interesting world. It is very addictive also. So and it's if you know the game, you can earn money consistently also. So how you can earn consistently trading options? You have to learn progressively. Today is the introduction session for future and options. So future and options are two separate instruments to start with, because many people say, or whenever we speak about derivatives, it is spoken as future and options or FNO. So people think that both are same. No, both are not same. Both are derivatives, but futures trading is different, options trading is different. So these are two separate instruments. The rules of the game, how you trade, how you do the analysis, how you take position, will be defined separately for futures, and it will be defined separately for options. So the rules of the games for futures is separate and options is separate. You should not mix both while trading or while understanding. So you have to keep your understanding separately. Third is these instruments, like people say it is a very risky instrument, future and options, you should not touch, it is very risky. I would like to clarify one thing. The future and options trading is as risky as trading in any stocks. Only difference is why it can be less risky, why it is said to be more risky, because in stocks, when I'm buying a stock, let's say if I'm buying a share of Reliance, I can buy for 50,000, I can buy for 75,000, I can buy for 80,000, 1 lakh, 1.5 lakh. But in futures, the minimum amount which is with which the trade value of, how to put it, the minimum trade value will be anything 6 lakhs and above. So in stocks, you can reduce your position size to 1 lakh, 50,000, 5,000, like that. But in futures, generally, the trade size is 6 lakhs and above. So whatever loss or profit will happen, that will happen on 6 lakh rupees. In stocks, you can reduce the capital and the profit loss reduces. So you think that, okay, no, it is less risky, stock is less risky. No. In percentage terms, both are equally risky. Only thing is the game is bigger in futures. Everyone clear? There is no risk, is not more or less, it's only the size is bigger. That's why the risk or the losses seem to be bigger in future and options. Now, moving forward, okay, let me ask you one thing. How do you earn money in stocks? How do you actually have money in your pocket when you earn money in stocks? First, you buy a share or a stock. Let's say you are buying Infosys for 1400 rupees. You buy the share, and in 5, 10, 12 days, 20 days, it goes to, let's say, 1500. Then if you sell the share at 1500, then you will earn money. 1500 minus 1400 equal to whatever is your profit into number of shares. Correct? How many of you agree that this is the only way, if you're buying a share, and if you can earn money when the share price goes up? Correct? You buy at a lower price, sell at a higher price, and you earn money. Correct? Agreed? How many of you agree? Yes, no? Can I have yes, no from all of you if you agree? Yes? Okay. Now, suppose, let me show you a chart and then we'll go. Now, if I have to earn money in Infosys, this is an Infosys share, and if I have to earn money, then the only way is I'll buy it here somewhere around 1400, and I will sell it when it goes up. So for earning by trading in Infosys shares, I can only earn money if I'm buying at 1400, and when it goes to 1500, I'll sell it and I will earn money. Correct? In shares, can we sell here first that, okay, I sell at 1600, can I sell the share at 1600, and when it goes to 1500 or 1400, I can buy back and earn money in shares when trading in shares? Yes. Okay. I'm not talking about intraday. I'm talking about, let's say, if you sell the shares and buy again after, let's say, 5 to 10 days or something like that. Yes, no? Can you do it? You can sell at 1600 and buy it back at 1500 or 1400 in stocks. I am asking in stocks, can you do that? If you're trading in shares, can you do that? Okay, so I'm getting answers from people who know future and options. The people who don't know future and options, what is your opinion? Can you do this? Okay, don't know. Okay, Vilasha is saying don't know. No. Okay, how many of you have traded stocks at least? How many of you here have traded stocks and not traded? You have not traded stocks. Okay. Okay. Hold on. A little. No, no, wait. Let me clarify. People who know trading future and options, maybe this is a very basics lesson for you. So if you already know future and options, then webinar today is not of much value addition. Those people who don't know about future and options, today's webinar will be useful because I am going to teach you about the futures. Okay. How many of you have traded in stocks, like you have bought and sold? Can I have yes from all of you? Those who are doing future and options, I would suggest today is not more much of value addition to you people for joining today. So it will be more value addition to people who are only trading in stocks. Okay. You want to be around, you are most welcome. Okay. So how many of you have traded, bought stocks and sold stocks and made some money or lost some money? That is also okay. Can I have yes from all of you? Okay, so Anil is saying yes, 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 yes. Okay, okay, Abhijit, okay. Okay, now my question is, do you agree with me that we can buy, when we are trading in stocks, we can buy at 1400 and sell at 1500, we'll be able to earn money, correct? You agree? Everyone agrees in stock? Yes. In stocks or in shares, when we are trading only in shares, can we sell first here at 1600 and then buy it back at 1400 and earn 200 rupees in stock? Because formula is same, right? Sell, higher price sell, lower price buy, sell minus buy, we should be able to earn 200 rupees. How many of you think you can do that? No. Okay, Abhijit is saying no. How about others? Okay, Nupendra is saying, Nupendra, how you can sell the shares first and buy later? Okay, I'll allow you to unmute. Can you like how you can sell the shares first and buy it later, maybe after 5-10 days and earn money?
No, I'm talking about the option.
No, 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 no. That's what I clarified in between that. Okay, I'm like this webinar is for people who only have traded in stocks. They don't know about futures, because I'm going to introduce about futures today.
Okay.
Okay, so so my question and answers will be based purely for the people who know to how to trade only stocks, not future and options.
Yeah. So
Okay.
in stocks, if you have already, then you can sell it. What else I?
Yeah. So you need to have stocks, correct? Absolutely right. What you are saying
Yes.
is absolutely right. If you have in your pocket 1600, you sell again, buy at 1400. So the stock comes in your pocket back again, and you are having 200 rupees profit, you can say, by the way. So you have to buy at some price, sell at 1600 and buy. So it's a complex method, but in normal course of action, I will not be able to do that for the stocks, except for intraday. Correct. Great. Thank you. Thank you, Nupendra. Okay, so I'll mute you. Okay. So in normal conditions, we cannot do, but there is an option. There is a possibility that you can sell it first and buy later so that you can earn money. That possibility is called futures and options. So today I'm going to introduce to you futures trading. Futures trading is easier than options. So I'm just introducing the concept. Maybe sometime we'll take up the options webinar as well. So how many of you want to know how to sell first and buy later? Yes, no? How many of you want to know how to? Okay, great. So let's say I'll explain you it with an example. I would explain you this with an example. Okay. Now, can you see my screen? Something written cloth manufacturer, bulk purchaser and all. Can I have, if you can see my screen, type yes. Can someone type yes? Okay, great. Thank you. So I'll explain you futures trading by taking some hypothetical example. I'll take one example. hypothetical example I'll try to explain you, and then we'll connect it with the stock market. So there is a story. So there is a Mr. A. We have three characters in our story. One is Mr. A, one is Mr. B, and C will come later. Mr. A is a cloth manufacturer. He manufactures cloth. He manufactures cloth in bulk. He manufactures white cloth, cotton, white cloth in bulk. He has his own factory. People are working in the factory. He has come to the cloth market where the purchasers buy cloth in bulk. So they will not purchase in 1 meter, half meter for one handkerchief. No, they purchase in lots. So there are bulk buyers, bulk purchasers in the cloth market. They will buy from the manufacturers. Just for story's sake, there is only one day when the entire transaction takes place. All the manufacturers are asked by the cloth market to bring it on a particular, their cloth on a particular day to the market and sell it. So in between, what has happened is our Mr. A has gone to cloth market and he met with Mr. B. Okay, so now he was speaking with B and he asked Mr. B, okay, Mr. B, what is the rate going on for one lot of cloth? Okay, so they will sell in lot. So he asked him, okay, what is the rate going on currently? If I bring my lot today, one lot of cloth today, how much can I sell it for? So B told, just now we had a deal, and on 29th March, the current rate of that lot, the entire bulk of cloth, which is they have measure, is going for 8 lakh rupees. So far, so good. Now, the cloth, one lot cloth of Mr. A will be ready on 27th of April next month. So manufacturing is going on. So it will take approximately 1 month to manufacture, and he knows that, okay, I'll be able to bring in one lot of cloth by 27th of April. So just a reminder, today's date is 29th March 2023. A will have his cloth, one lot cloth ready by 27th April 2023. Rate of one lot of cloth in the market as of today is 8 lakh rupees. So 8 lakh rupees, one lot is being sold. So that means if he brings his one lot cloth today, he will be able to sell for 8 lakh rupees, but his cloth will be ready only on 27th April, which is next month. So he just came for knowing the market price. Now, because he is in the business for quite some time, he feels that the rate of this cloth will go down. Okay, today, if someone is bringing the cloth, manufactured cloth, he's able to sell for 8 lakh rupees, but Mr. A has his own sources and analysis, and he believes, he has a view. He has a view that the rates will go down in coming days, and they will be around 7 lakh rupees for one lot. Okay. So now, if he's bringing on 27th April, will he get more? And okay, and B, Mr. B, his view is that the price might go up by 27th April. B has his own analysis, A is having his own analysis. So A is thinking, view of A is by the time 27th April, he brings the one lot of cloth price will go down, it will fall, and he will be able to sell it for 7 lakh rupees. The purchaser, in his heart, he knows, he is having a view that, okay, there can be some shortage or something like that. And there is a possibility, he has a news that there is a possibility that the cloth will become costly by 27th April. So how many of you, the picture is clear what is happening? A and B are sitting in front of each other. Rate of one lot of cloth as of today is 8 lakh rupees. A will be able to bring in his one lot cloth by 27th April 2023. He thinks, he has a view, as per his analysis, he has a view that the rates will go down. Instead of getting 8 lakhs on 27th April, when he brings his cloth, he will get only 7 lakh rupees for one lot. Whereas Mr. B, who is going to buy, in his heart, he's thinking, boss, when he brings 27th April, by that time, the rate of cloth would have increased to 9 lakh rupees to his lot. Picture clear? Everyone is clear? So far, so good. Any questions so far? Can I have yes if the overall picture is clear to everyone? Yes, okay. Now, they want to do something about it. So they want to do something about it. What they do is they agree ki let's enter into a, just hold on, just hold on. What is happening? Okay, just give me one minute. So what they do is they sign a contract. A and B, they say, let's do one thing. Let's sign one contract. So they bring in that stamp paper and all. So on that, what contract they sign? That on 27th April 2023, which is 1 month from now almost, A will bring one lot of cloth and give it to B. On receiving that one lot of cloth, B will pay 8 lakh rupees to A. So they have signed a contract that A will deliver one lot of cloth on 27th April to B, and B will pay 8 lakh rupees to A. So they have locked the price. They have done a deal. They have done a strike price. What is the strike price? They have done the strike at deal value at 8 lakh rupees, and they have locked it. And this contract, they have signed the contract. So they are bound by the contract. Now tell me, is A happy by signing this contract? Is A happy when he is signing the contract? Yes, correct, no? He is happy, correct? Because he thinks it will go down. So he is happy that, okay, when he is bringing the cloth, it will, he'll still get 8 lakh rupees. Is Mr. B for Bombay happy to sign the contract right now? Both are happy, correct? And Sanjay rightly said, both are happy. Both are happy because both have their views. Both are happy because they both are having their views, and they have protected their interest by having that view. Now, that is one. Second, has the actual trade happened today? Has the actual trade happened today? Has actually A given the cloth to B and has actually B paid 8 lakh rupees to A today on 29th March? Actual trade has not happened, correct? Actual trade, when will the actual trade happen? When will the actual trade happen? 27th April, correct? 27th April. On 27th April, because on 27th April, he'll bring his material and he will give. So actual trade, exchange of money and one lot of cloth will happen on 27th of April. What has happened, what is being traded today is contract. They entered into a futures trading contract that in future, which is 27th April, I'll come to you, I'll give you one lot of cloth, you pay me the money. So they have entered into a futures contract. That's why it is called futures trading. In Hindi, it is called Vaida Vyapar. They give Vaida, they promise Vaida Vyapar that I'll bring one lot of cloth in future and you pay me. So in Hindi, it is called Vaida Vyapar. In every language, they'll have some, it's a promise. It's a promise to be executed in the future. So it is called futures contract. Strike price is 8 lakh rupees for one lot of it, and execution day is 27th of April 2023. Okay. Now, so what is the underlying? What is the underlying? When I'm saying they made a contract, they made a futures contract. But in futures contract, what they wrote was one lot of cloth. If the cloth, the product itself was not there, if the product itself was not there, product itself was not available, can they make a contract for future? If let's say there was nothing like one lot of cloth, can they make a contract of buy and sell? What they will buy and sell in future? They need something in future to be traded, right? That's why they are doing the contract today. If there is, the product itself is not there, what will they exchange in future? So the underlying, that is called underlying, the contract underlying, the contract for which they have signed, the contract underlying is called one lot of cloth. This contract is derived out of that underlying. So there is one lot of cloth which has to be exchanged in future. Because of that underlying cloth for which they will exchange in future, they have done a contract. So they have derived that contract for that one lot of cloth. That's why it is called derivatives trading. So you have learned two things. One is the futures contract and why it is called derivatives, because that it derives the contract derives its value from the underlying. Now, important point here is, can we say A is a seller of the cloth here? He has already sold in the contract. He is a seller. Can we say, can I say the cloth manufacturer is a seller in the contract? Seller of the cloth? Yes. In the contract, B is the buyer of the cloth. Can I say? B is the buyer of the cloth. Yes. Then now, one more thing comes in, that who will guarantee that A does not run away? Let's say the price goes to 9 lakh rupees. Okay. The price, if the one lot cloth price goes to 9 lakh rupees, A can as well say, no, I did not enter into your contract. I am not supplying cloth to you. I'll go to some other buyer and sell him for 9 lakh rupees. Correct? He can always say, A will say, no, I don't give it to you, I'll give it to someone else. Or if the price goes down to 7 lakh rupees, then B can also always say, ki, I am not buying it from you, I'll buy from some other supplier. Why I should pay you 8 lakh rupees and buy it from you? So there is a chance that either of them can default. They'll say, no, I'll not do business with you, I don't recognize this contract and nothing. So we need a authority over and above this. So for hypothetically, for our story's sake, let's call it as a cloth market association, cloth market traders association. In our stock market, it is NSE, National Stock Exchange, and Bombay Stock Exchange. They make sure that the contracts are honored. In our story, we'll say cloth market association, traders association. They will call both of them, okay, A and B. They'll say, boss, we don't know. Okay, we are here to execute your contract, but both of you have to keep some margin money with us. So this fellow will say, why I should keep 8 lakh rupees with you? We will be doing it, trading at the end of the month, after 1 month, why we should give? They'll say, no, we don't want 8 lakh rupees from you, but to ensure that neither of you defaults, and if you default, we'll be able to help the other party. Both of you will have to keep some money with me, margin money with me, that in case you don't turn up, in case you default, we will use that money. That is called margin money. Both have to keep 1.5 lakhs, 1.5 lakhs margin money with the traders association. So now here we have to understand, see, with keeping a margin money of 1.5 lakh rupees, they were able to enter the contract of how much value? They gave 1.5 lakh rupees as a margin money to the traders association, and they were able to trade or enter into contract for how much money? What is the contract value? 8 lakh rupees, correct? They were able to trade 8 lakh worth of contract by keeping a margin money of 1.5 lakh rupees. This is called leveraging. This is called leveraging, where you are able to trade higher values by keeping a lower margin money. But you have to remember, your profit and loss will happen at for 8 lakh rupees only. If your profit and loss will happen at 8 lakh for the value of 8 lakh rupees, but to trade for 8 lakh rupees, you have to keep only 1.5 lakh rupees. This is called leveraging. You got the leveraging. So they kept and done. Okay, so they will wait for 27th April and all. Now, what happens is, let's go take our story little in future. So we are right now on 29th March. Let's take our story to future date. Okay. Now what happens is, there is a manufacturer C. Okay, ABC, third character. No? So there is a manufacturer called C. Now, C is also having his factories running, everything. His cloth, one lot cloth will also be ready on 27th April 2023. Now he is coming to the market. For hypothetical sake, or for the story's sake, the date today is 12th of April. So 29 to 12, some 13-14 days have passed. The price will change every day. The price of cloth changes because it's a market, cloth market, so it will change. So Mr. C asked Mr. A, what is the rate going on right now in the market for one lot of cloth? He tells right now it is 7 lakh rupees. Now again, view of C is that acha abhi 7 lakh mein it is going on, but by the time I'll come in the market, it will further go down to 6 lakh rupees. That is C's view. The manufacturer C who has come, his view is that it may further go down. The things are not looking good, and by the time he brings in his material on 27th April, it will go down. But now the view of A has changed. Earlier on 29th March, his view was that it will go down. Now it has come to 7 lakh rupees. Now his view is that it will go up from this point onwards. It will become 9 lakh rupees. So what A says is, yeah, let's do one thing. Let's enter into a contract wherein you bring in the material and sell it to me for 7 lakh rupees. So now C's view is it will go down. A has changed its view that it from here it might go up. So they both signed the contract. What contract is signed? That C, Mr. C will bring one lot of cloth on 27th of April and give it to A for 7 lakh rupees. So execution is on 27th April. What is the underlying? Underlying is again the cloth. Now for in this situation, C is the seller of the cloth. A is the buyer of the cloth now for this contract. So between A and B, B for Bombay, A was the seller and B was the buyer. In this contract, C is the seller, A is the buyer in this contract. So he has taken a buy position in this. Can we see that he sold on 29th of March, A sold the cloth for some future date. By 12th of April, he changed his view. Now he has entered into some other contract where he has become the buyer. So how many of you are getting it that he sold first and now he's entering to buy? He sold at 8 lakh rupees and now he's entering into contract to buy at 7 lakh rupees. So sold at 8 lakh, bought at 7 lakh rupees. Clear? Understood? Yes, no? Type yes if you're getting the picture. Okay. So margin money again for this contract, both of them will have to keep 1.5 lakh rupees for this deal. Exactly itna aisa nahi hota hai. It will not happen like this on the platform, because if you have bought and sold, it will get squared off the same day. But just for hypothetical sake, I'm saying that. So both have to go and say on the margin money. And what will happen on 27? Let's say what may happen is A on 27th April, A will receive cloth from C, give him 7 lakh rupees. On 27th April, after the market closes, he will take from C for 7 lakh rupees and go and deliver it to B for 8 lakh rupees, earn 1 lakh rupees by this transaction. So he took one lot of cloth from C for 7 lakhs, went and gave it to B for 8 lakhs. He earned 8 lakh rupees with a margin money of 1.5 lakh rupees, which he kept with the Traders Association. So he kept a margin money of 1.5 lakh rupees and he earned 1 lakh rupees by this transaction. So the percentage return on the capital blocked, which was 1.5 lakh rupees, it becomes huge. It almost 60% returns for him in 1 month. But actually, if we say he traded for 8 lakhs, so 8 lakhs, the change in the value was 1 lakh. So it's almost 10-12%. So if someone traded on stocks, he would have to put upfront 8 lakh rupees. But since he is only trading with the margin money, he gained 1 lakh rupees on 1.5 lakh rupees like this. So my question to you all is step by step. Okay. First, is the futures trading happens today or for future? The contract is entered for the future. If you think today, type T. If you think the trading will happen in future, type F for future. Future. Correct. So today they only enter into contract. The deal value is 8 lakh rupees. So you can be a seller. You can be a seller of the product first. In the future, in the futures contract, you can be a seller today, even if you don't have a product. Correct? You can sell a product, even if you don't have a product right now in your pocket, you can sell a product. Yes, in a futures contract, you can be a seller. You say, I'll give in the future. No, don't worry, I'll come there. So you can be a seller of the product. Then you can. So margin money required by the exchange is somewhere around 20-25% of the actual deal value. So deal value of 8 lakh rupees, you have to keep only margin money of 1,50,000, something like that. Some 20-25% you have to keep, and you can trade for 8 lakh rupees. You can square off in between. You can come out of the trade in between, like the A. First he was a seller, and later he came out of the contract, and he like it's as good as handing over his contract to C, and you can come out of the contract on the money. So you can sell first, buy later. Now here, taking this example here. So everyone clear? Any questions? Let me take questions. If you have, then we can go ahead. Then I'll explain some finer details. Don't leave till you understand all the finer details. I'll allow you to unmute. If someone has a question, let me know. Please unmute and ask the question. Any questions so far? Anyone? You can unmute and ask the question. No questions? How it is possible? Either.
Sir, I have a question.
Huh.
For example, if the market falls, then then can C come out of the contract in between?
Yes, he
If the
will
market
have to
rises,
find some D.
Sorry, B. If the market rises, and say assume that he has got 10% more than what was his expectation, can he get out of the contract?
Yes, yes. Anybody can get out of the contract any time. He can say he will find someone else. No, see, it's all the game of views. See, what we have seen here is everyone is having a view. Correct? What may happen in the future. So in every market, buying and selling happens only when the buyer thinks it is going to go up and the seller thinks when it is going to go down.
Right.
Correct? Infosys also, if you see the volume, correct, if you see today's volume, there was 8.814 million shares were traded. That means there were people who sold those shares, they thought it will go down, and there were 8.114 million people, or this much amount, they thought it will go up, so they bought it. So for a trade to happen, there has to be buyer and there has to be seller. So at any given point of time, there are people in market with both the views, buyers who will think it will go up and sellers who will think it will
So
go
we
down.
can trade in futures with strict stop loss as we do it in equity markets.
Sorry, come again.
Can we trade in futures with strict stop loss as we do it in equity markets?
Correct. You have to trade with stop loss and all trading strategy. But you can come out. If you are a buyer, you can come out. If you are a seller, you can come out. You have to just like technically you have to click a button, but actually what is happening is you hand over your contract to someone else.
Okay.
Like that.
Right.
So you can come out anytime. You can come out. If you're buying, if it goes down, you can come out. If you're selling, it goes up, you can come out. Yes.
No, I believe this is a much better option than what we do, like mad options, because futures are better than trading in options.
No, both has its own advantages. I will cover options and then we will compare future and options both.
Okay, sir. Right.
Option has its own, personally speaking, options is more safer than trading the futures actually. So from safety point
Option
of
selling,
view,
you mean to say?
option selling or option buying, either way, it is little more safer than futures. That's what I feel. So option is a better option.
Because for years together, even today, I'm trying to break even, but I've been doing option buying. Like I've gone to trades, I've said no anymore, and started learning option selling. Right, sir. Anyway, look forward to your advice.
So we will take options later. I'll do a session on options and then we'll discuss options there.
Sure, sir. Sure.
Yeah? Okay.
Right.
Okay. Thank you.
Sir, at any point of time when any one of the party moves away, moves out, so will he lose the deal money? Will he lose the margin money?
No, margin money he will get back. No, see, he has entered into contract for 8 lakh rupees and he closes his contract. He cannot close the contract, right? So he can close the contract. A and B can meet and they say, okay, chalo, as contract, let's come out of the contract. So they can go to exchange, because we both are coming out of the contract. Give us our margin money. So exchange will return back their margin money.
Oh.
Because exchange is holding the margin money, because exchange wants to ensure that none of you runs away. But both of you have agreed that we don't want to be in contract. The exchange will say, why I should hold your money? You take your money back.
Okay.
When A and B enter into contract and A goes to C, so A was a seller in the contract 1 and A was a buyer in contract 2. Again, for him, for A, buy and sell both gets combined, it becomes 0. He is out of contract, he is neither having the contract, so he can come out, his margin money will be released. So his contract will be squared off. He'll get 1 lakh rupees in between by 12th of April and he can come out. Okay. Okay, yes. So let's go ahead and we'll take more questions as we progress. Okay, so we have understood. So same thing will happen. Now see again, what will happen is, if Infosys is, let's say, at 1600, for example's sake, 1600, and by doing the analysis, you find, okay, what we will do, we'll do some technical analysis, right? How do we develop our view? We develop our view by technical analysis. So if someone is doing technical analysis, he will see, okay, theek hai, ye bearish engulfing hai, and the wicks are longer, forming wicks are longer, this is going flat, it is likely to go down. So what he would like to do here, if he wants to, if someone is of opinion that it is going to go down, what will he do? Sell. Now, like I said, this is a wholesale market. Okay, this is a wholesale market. This is not, you cannot buy or sell 1 meter of cloth, 1 handkerchief, 1 t-shirt. No, you have to buy and sell in bulk. So how many shares can he sell? This is the NSE website. Let's see, Infosys. Okay, it has gone. If you type here Infosys, here it has come. Let's see, derivatives. Now we all know what is the meaning of derivatives. It derives its value from the underlying, and then all contracts. Let's take the stock futures contract. And this is the stock future. See, the date is written 27th April. That means if you are selling Infosys at 1600, what date you will have to go and give those shares? You will have to go on 27th April. How 27th April has come, I'll explain you in 10 minutes. Now, if I expand this, here it is written market lot, means I cannot trade in 1 or 2 or 10 or 15 shares. Minimum I have to trade in 400 shares. Everyone can see this market lot here, 400. Yes. So minimum size of Infosys that I can sell. So if I do analysis, I say, okay, it is going to fall. So minimum I have to enter into contract to sell 400 shares. I'll have to sell minimum 400 shares. So different stocks, there are around 200 stocks which are allowed to trade futures. Different stocks will have different lot size. This is the lot size which is mentioned. If you want to do in, let's say Indian Oil Corporation, you will have to sell 9,750 shares. That is called the lot size. So this is the minimum lot which you have to sell. Now Infosys, if I have to sell minimum 400 shares, 400 into 1600 is 6,40,000, correct? 1600, if I am selling at 1600, and if I have to sell 1400 shares at 1600 rupees, I have to enter into contract, right? If I'm selling at 1600 rupees, then my contract size becomes worth 6,40,000. 1600 into 400 number of shares. So I am entering into contract worth 6,40,000. To enter into that contract of 6,40,000, exchange will tell me, okay, you are entering into contract, but we have to ensure that you promise fulfill your dream, fulfill your contract to deliver. You will come and give 400 shares to the buyer. Please keep the margin money of 97,589. They decide on based on volatility and all like that. Higher the volatility, higher is the margin. So they will take this much margin and say, okay, you will have to keep this much caution money or margin money with us. You can trade, you can enter with the contract. So Infosys, so this is the list of all the lot size and margin money required. I'll share this. This is from Kotak Security. You can go and refer here. I'm sharing in the chat with every one of you. You can copy paste the link. Copy paste the link for future reference. Now, I have, so Infosys, someone sold here. After a few days, they buy here. 200 point, it has gone down. So, and let's say if we do analysis again, now it is going sideways. There is a longer wick at the bottom. There is a likelihood that it will go up. We exit at 1400. Let's say if it is going up, we will exit. So we decide to exit at 1400. So what will be our gain is 200. 1600 pe sell kiya, 1400 pe will buy. Sell minus buy is 200 rupees price into lot size is 400. So 80,000. 80,000 we sold somewhere here in 1 month. We got 80,000. How much money did we block? We blocked the capital of roughly 1 lakh rupees. We gained 80 lakh rupees. So in 1 month, the return for our money blocked or money invested, the return is almost 80%. That's why people get attracted towards futures and options, because the return on the capital you invest in future and options is very high. Within 1 month, the stock went down by hardly 10 to 12, 15%. But in futures, money, whatever you block, you get that much returns. So 1 lakh rupees for 1 month, you get 80,000 rupees. Everyone clear? and you lose also, huh? Because someone has purchased, someone has bought also. So he must have lost 80,000, someone must have gained 80,000. So it's I don't think that people will earn only, people lose also. But it's a big ticket game. It is having the same risk as stock. Also, in stock, you block that much money. In futures, you are playing with leverage. Hence, it is said it is more risky because you lose big money as compared to your capital, not as compared to the trade value. If you are trading for stock 8 lakh rupees, pay, you will lose 80,000 only. But if you are leveraging, then you are losing 80,000 on 1 lakh rupees. So that's why they say it's more risky, but like that. Okay, so before why they took the date as 27th April? Why the date of the contract is 27th April? Because exchange has decided that we will not sit every day, or you cannot put your any date you want that, okay, I'll give delivery on 15th April, 16th April. No, not like that. We will only decide. We don't have time to do all this. So only once in a month, we will decide everyone is fulfilling the contract or not. So it is decided by stock exchange that last Thursday of the month will be settlement day. You bring your contracts on last Thursday of the month, and we will be settling the contract in April. Last Thursday of the month is happening to come on, where is the date? Where is the date? Where is the date? The date is 27th April. So last Thursday in April is 27th April. So we can take the contract will be closed on 27th of April. What date, which is the last Thursday in March? What will be the contract date for March 2023? What is the last Thursday? Last Thursday of the March month. Tomorrow, correct? 30th. Tomorrow. Absolutely right. So the expiry ideally should be on 30th of March for earlier contracts. Whichever contracts happened on 1st of March, the expiry should be on 30th of March. But since tomorrow is Ram Navami, tomorrow the exchange is closed, tomorrow is holiday, the contract will shift, and the contract closure date was on the Wednesday before the Thursday. So that you have to remember. On an average, all months, the contract date will be the last Thursday of the month. But in case the last Thursday of the month is a holiday, the contract will close one day before. Like in this month, the contracts have closed today. Today is Wednesday, but they have closed the contract because tomorrow is holiday. So they have to close the contract one day before. Third thing is very, very important. You have to understand is expiry is last Thursday of every month. It's a delivery based system. So Anil was asking, what if we are having loss? Can we take the delivery? Yes, you can take the delivery. If you are going in loss, because now in India, it is a delivery based system. Earlier, it was cash based system. So instead of coming out, you say, okay, I'll take the delivery. If you bought at 1600, the price has come down. If you don't want to exit the contract, you can take. That is a problem also, which people forget, that they have to take. This is not the option. If you don't come out of the contract, you will have to take the delivery. So you can start the trade with 1 lakh rupees, but in case you don't close your contract, because this is a contract, this is an agreement that to be executed, it will be auto executed on the last Thursday of month. That day you will have to give 6 lakh rupees and take the delivery of the instrument. So even if you start with 1 lakh rupees for 6,40,000 worth of trade, but if you let it expire, let the contract cross the last Thursday of the month, you will have to take the delivery of the shares. You will have to pay 6,40,000 and take the delivery. If you have sold the futures contract, you will have to give the delivery. Okay, so don't hold any contract till last Thursday of the month. If you are holding any contract till last Thursday of the month, exit if you don't intend to take the delivery. If you don't have money, just take some losses and exit. Okay, you must have seen you'll see nowadays it is not coming, but a lot of people, they did not know this rule and they suffered a lot of losses because SEBI says, okay, if you don't have money in your account and still you don't know the rule, there will be fine. They have to pay hefty fines. Then check the lot size and margin money to be maintained. Always have an exit plan. So this is purely based on technical analysis. Futures trading is not at all based on fundamental analysis. We don't care whether the stock is good or bad because we can sell first, buy later, buy first, sell later. So it doesn't matter for us whether the stock is fundamentally good or not. So the game here is a purely technical analysis based on the stock price movement. So that's why you should be very clear how the prices will move. So you should be able to anticipate the price movement by a technical analysis. So that's why the technical analysis is of prime importance in futures and options trading. If my delivery date is in May, can I hold till May? Yes, you can hold till May. Yes, absolutely. So it's a 3 months contract also. We have 3 months possible. April is the near month. May is the middle month and June is the far month. That is how it is done. Okay. So with this, we come to the end of session for the future. So how many of you have learned something new today? Can I have yes from all of you if you have learned something new? Something exciting, something new? Great. So good to see. Difference is the date only. You can have a contract for 1 month, 2 months, 3 months like that. There is not much difference. Sometimes the price difference is there. Okay. So if you have any questions, you can unmute yourself and ask the question. Anyone having any questions regarding the futures? I'll upload this webinar. You can go through it. And if you have some questions later, you can ping me. That is also possible. Okay. So no questions. How to hedge if I am going losses? You can hedge in by options only, I think. Hedging instrument is options instrument only, what I understand. It is better to have an exit plan in futures. That's why I said options is a little better way to trade, and you can like there are options. You have a lot of flexibility, right? So we will be learning options sometime later. Today is futures, so definitely please attend for the option session. Okay, so great. Thank you so much for joining today. See you all on next Wednesday. Till then, have a great week ahead. Thank you so much. Thanks a lot.